Hi, and welcome to this morning's Global View Trend View video analysis. It is currently 9:20 a.m. on Wednesday, February 3rd, 2016. Coming to you quite a bit later than usual because of a couple of influences we absolutely felt we had to see, and we'll discuss those momentarily, including the U.S. ISM services indications. But maybe even more importantly, while it only is seeming to really impact the markets today, New York Fed President Dudley came out with some comments that were rather more dovish than his usual view of the markets and of the economy, and this has had quite an impact. It's kind of like the ecstasy and then the agony as the market digested that. We'll be back to that momentarily. So, what has all this meant to the markets? Well, you can see between oil prices being up a little bit overnight on more what we consider dubious talk of the potential for production cuts, and Dudley's comments leaving people feeling maybe the Fed might be less hawkish than people believe, especially compared to other central banks. The S&P opened up sharply higher, up at 1908 off of yesterday's close at 1897. But literally, as you can see on the 30-minute chart, because we've already been open for a while, the market immediately dropped back down to the key support at 1895, which we noted yesterday probably had a tolerance to the top of the gap from Friday's gap higher on the BOJ surprise cut to negative rates. And where do we end up here? We end up with a market that looked kind of bad yesterday, tried to clean up. I think that was off of what Dudley had to say, etc. But then if you think of the context of, well, the Fed did raise rates, was that rate hike a mistake? And that seems to be what the market is reacting to right now, as we're down from 97 late yesterday, $20. And yet, we must point out, much as last week, and we're going to look at the longer-term charts for a picture of this, with the market breaking up, as it did, going back to late last Wednesday, 2 weeks ago Wednesday, into Thursday morning, on the ECB's more accommodative stance, what we saw was a market that was ready to push higher. And this was very important for the fact that from what we saw at that time, the market was above 1865 to 60, left this gap higher, left this up break, and we'll see how that's important on the long-term charts as well, and could never get back below 1865 later on last week prior to the BOJ boosting all the markets once again. So we will have a very important area down at 1865 to 60 on any retest, and we're getting closer to it, and it will be probably pretty important into the next big data, which is going to be, of course, Friday's U.S. employment report. And what we have for now, though, is the advantage accruing to the bears, because as of later on yesterday, in spite of the temporary pop higher late yesterday, especially in the higher opening this morning, rather than holding that 1895 low end of 1902 to 1895, it eroded through it. That's right at the moment where the hourly MACD escaped its lower runaway band, which, as you know, we always consider an important area down there at -2. And that leaves the momentum to the downside. And that's what's going to make 1865 to 60 that much more important once again. And that pretty much does it for the short-term view of the S&P 500. See what we've got there. And that is also very important right now because, again, going back a couple of weeks ago when the market was under pressure, it cracked at 1865 to 60. And as we pointed out right along, that was no mean Fibonacci support, and the low of the pullback in September and some other previous congestion. That was the broadest channel, the broadest parallel channel you could project off the major low back at 666 in 2009, the major cycle low after the '08 into early '09 crisis. And that's using this top line as a reference line. And yes, it's a line hanging in space, but it is the key level. Now, some people have asked me about this straight trend line off the lows in '09, and again, after that significant reaction that also looked scary at the time back in October of 2011. And that trend line is very interesting, but you have to remember that with that as your reference line, this was the topping line, and the market accelerated out above it in late 2013 above the 1777 area. So the next real support, even though we held the low 1800s, is down into the upper to mid 1700 area if the market should get bad again. And here we are, even as we speak, down into 1767.50 low, and you can see this 25% retracement on the monthly chart as well. So after rebounding back above this, going back 2 weeks ago into last week, can a market that's under sharp pressure again from the Fed acknowledging that, gee, maybe things are weaker than we thought, maybe our normalcy bias was misplaced and thinking things were getting back to normal, can it survive the next test? We shall see.